We just wrapped going through Microchip's fiscal 2026 fourth quarter earnings call materials, and now we want to share our takeaways with you. Here's the thing, this company just put up a monster quarter, revenue ripping 35.1% year over year and beating the top end of its own guidance. But the headline isn't the comeback, it's the twist underneath, because the problem flipped from nobody ordering to not being able to make enough. Demand is back, so the real question now is whether they can get the parts to ship, and that's exactly what we're digging into today. Let's start with the number, because it's a big one. The filing shows fiscal 2026 fourth quarter revenue hit $1.311 billion, up 10.6% sequentially and up 35.1% from a year ago. The company stated that beats the top end of its own guidance, so the bottom is in, no argument there. But don't just stare at the green. The real story is the turn sitting underneath it. For a year or two, the bottleneck was demand. Customers sitting on too much inventory, nobody placing orders. The company stated that has officially flipped, and now the constraint is sourcing enough substrates and wafers to actually deliver. Same company, the pain point jumped sides from a demand floor to a supply ceiling. Our take is simple, this is a self-repair story heading into its final act. How far the rebound runs depends on supply, on whether they can get the goods, not on whether demand shows up. So what does this company actually sell? Let me give you the picture in one shot. That cutting edge AI GPU and engine, the 3nm stuff, that's the race car engine, flashy and expensive. The company stated Microchip does not build that engine, and 3nm nodes are flat out not their focus. What they make is the wiring and the screws the whole car needs to even run. The report lays out the lineup: microcontrollers and analog for the foundational logic and the power regulation. Then connectivity and storage controllers, the parts that handle the wiring and the memory. And FPGAs, the programmable logic gates, the flexible brains sitting on the board. None of it is sexy, right? But the machine does not move without these pieces. The company stated their revenue is a direct proxy for global industrial cycles. Our take is, when the industrial world heats up, this company heats up right alongside it. So now here's the moat, and it's a beautiful one. They call it the lock-in. The filing shows the price gets locked at the design phase, guaranteed for the product's entire life cycle. Once that chip is designed into a product, it rides along, and the report says that lifespan runs 30 years. Think about it, one design win feeds you for 3 decades. That is a sticky business. On scale, the company stated there are roughly 110,000 customers on the books, and nearly 50% of the business flows through channel distribution to service that long tail of smaller names. Here's the key thing, and you really need to lock this one in your head. Because half the business runs through those fragmented channels, channel inventory days becomes the ultimate leading indicator of cyclical health. Our take is, watch that single number. Channel stocked up means cooling, channel drained means it's heating up. Let's look at who the customers actually are, because the spread here is gorgeous. The report breaks it down. Industrial is the biggest slice at 31%, then data center and computing at 18%. Automotive is 17%, aerospace and defense 16%, with communications and consumer each sitting at 9%. Look at that. No single client can hold this company hostage. The risk is spread thin and wide. By industry logic, that makes the revenue a clean mirror of the broad industrial cycle. It lifts when the economy does. The company stated the strongest end market right now is aerospace and defense, and the strongest business unit is FPGAs. Here's why that matters. Both of those are long lead time, high margin pieces of business. A reasonable read is they take longer to win, but once you're designed in, the contracts run long and the margins run fat. Our take is that heavy weighting towards slow, sticky sectors is the structural buffer against consumer tech swinging wild. How did this company climb out of the hole? That's the whole 9-point recovery plan. First, just feel how ugly the bottom was. The report marks the March 2025 trough. Back then, gross margin was 52%, the operating expense rate 38%, operating margin a thin 14%, brutal stuff. Then they fixed it line by line, and the company stated 4 big pieces are already done. Footprint reduction, the megatrend pivot with AI replacing 5G, the business groups going from 2 pillars to 5, plus channel restructuring. 2 items are in the closing stretch. So the filing shows inventory clearing and margin expansion both sitting around 85% complete. 2 more are parked. The chiplet rollout is paused while they digest existing capacity, and the temp fab sale has buyers engaged but no closed deal. Our take is most of this puzzle is already built, and those last few pieces are exactly what we're watching from here. Alright, the main event, gross margin, and this is the one you really have to understand. The report shows the TRO margin was 52%, and this quarter it has already pushed up to 61.6%. That's nearly 10 points clawed back off the bottom. Not bad at all. So how far is it from the 65% target the company keeps talking about? The whole gap sits in one line item, a $46.6 million underutilization charge, the penalty for half-empty factories. The company stated that adding that penalty back brings the margin right up to the 65% long-term target. But hold your horses, the company also stated that penalty decays slowly, bleeding off over several quarters as volume returns. And they were dead clear. The 65% target is contingent on factory utilization, and it is not guaranteed. So the punchline in the title is the real tell. This margin recovery rides on volume, not on jacking up price. Our take is straightforward, fill the factories and that margin staircase climbs, one patient step at a time. We covered margin, now let's talk about the cash that drops to the bottom line. The report shows non-GAAP operating margin hit 30.6%, more than double the 14%, that is leverage ripping. Adjusted EBITDA came in at $466.8 million, up 132.9% year over year, with trailing 12 months at $1.496 billion. And non-GAAP EPS landed at the 0.57, beating the guidance midpoint by 0.07. But here's the catch, you have to know how to read the two different sets of numbers. The filing shows GAAP net income was only $116.4 million, just 0.21 of EPS, way under the non-GAAP figure. Why the gap? The company stated it's $107.8 million in MA amortization, $59.9 million in stock comp, and $6.4 million in Fab 2 closure charges. Our take is, most of that is paper, not real cash walking out the door. So to judge true earning power, a reasonable read is to anchor on the non-GAAP app and not get spooked by the GAAP optics. I'm calling this the 9th inning because the inventory cleanup is basically at the close. Start with their own warehouse. The report shows internal factory inventory down to 185 days. That's 16 days lower than the prior quarter and a long way off the 266-day peak with a target of 130 to 150 days. Now the channel, and this one is wild, the company stated channel inventory is just 26 days, a historic low. That means the distributors are running on fumes, almost nothing left on the shelf. On momentum, the report shows sell-through up 11.4%, with sell in nearly matching it, signaling the restocking phase has begun. I'm telling you, with the channel that bear, once it turns, the refill orders snowball. The balance sheet looks sharp too. The filing shows net debt to EBITDA dropping from 4.1 to 3.54, targeting under 3 next quarter. And the company stated that was supported by a 0% 4-year convertible issuance plus a $68 million cap call to blunt dilution. Now the real growth engine, the data center, and this is 3 arrows firing at once. First arrow, storage controllers. The company stated its Aptec Smart R8 NVMe took home the Nimbus Innovation Award. Read-write speeds running up to 3 times the competition. And the report ties that to agentic AI driving data persistence. 3 times, that's not a tweak, that's running the other guy clean over. Second arrow, memory controllers. The company stated the Gen 5 dual port part is entering mass production this very quarter. The filing shows those design wins are expected to ramp consistently through fiscal 2028 with industry-leading jitter tolerance. Third arrow, and this is the one that lights me up, SwitchTech running PCIe Gen 6. The company stated it landed 6 major design wins just 2 quarters after launch, every one of them pre-volume. It ramps to mass production by the end of this quarter, taking share across scale up and scale out. Our take is fire all 3 arrows at once, and that's the fuse turning this quiet name into an AI story. The second growth engine is even juicier, and it starts with a brand new market. The company stated Microchip broke into PCI retimers, landing a major OEM design win right out of the gate. It runs as a Gen 6 companion die, compatible from Gen 1 all the way to Gen 6, and it displaced a single vendor competitor. Why did it win? The report says it cuts the client's integration risk, 1 vendor instead of 2. On FPGAs, the company stated the PolarFire 2 is currently in fab, launching later this year. And get this, the report shows the initial sample batches are already 100% fully booked. Now the orders, and this is the part with real teeth. The company stated March book-to-bill ran significantly above 1, and April was the highest monthly order intake in 4 years. The filing shows the customer base expanded by thousands through relationship repair and new design to production transitions. Our take is, with orders packed this full and customers flooding back, is demand weak here? I don't think so. Things are ripping, so let me pour a little cold water, because this is the sober page. The question is simple, is this real structural demand or just a one-off restocking pulse? On the bull side, the report lays out the structural recovery, A&D, data center, and industrial all genuinely turning up. The company stated it also clawed back design win share it had lost and pulled thousands of customers back in. But on the other side sits the temporary stuff, the channel restock, plus those design win clawbacks. Here's the reality check. The report says that big quarterly surge is driven heavily by a one-off channel restock. Once channel inventory climbs back from 26 days to historical averages, the quarterly growth rate inevitably cools off. The report calls the full year figure, up 7.1%, a far more accurate read of the true cyclical center. Our take is, don't get blinded by one quarter of fireworks. Watch that annual number for the real trend. We've been on the highlights. Now let me poke at what management is dodging. First flag, long-term growth. The company stated it keeps pushing out its long-term commitments, citing growth being too aggressive to benchmark. Second flag, the data center split. The company refused to break out data center and AI megatrend revenue from legacy computing. The report says they cited investor confusion as the reason, which, come on, is a thin excuse. Third flag, September visibility. The company stated the September backlog is higher than June, but they actively refuse to hand over a specific growth range, so that number stays in the dark. Put those three dodges side by side, and what a company won't say is usually the thing that matters. By industry logic, this kind of strategic opacity caps how the market can price the AI story. Our take is, until the data center segment gets cleanly broken out, you apply a discount to that AI valuation narrative. So bake that reserve into your thinking. The silence carries a real cost. Enough of the good stuff. Now I'm hitting the alarm, because the bottleneck has flipped sides. The company stated 70 to 80% of its primary foundry partners' process nodes are currently restricted. To grab more volume, the report says it takes active escalation. You have to fight for every wafer. Substrates are worse. The company stated they carry a strict 12-month shelf life, so you cannot stockpile in a downturn. And they're racing right now to qualify alternate suppliers, which tells you how tight it really is. Then lead times. The report shows standard times stretching from 4 to 8 weeks. The company even projected nothing available within 4 to 6 weeks next quarter, with non-supported delinquencies rising. Here's the kicker. The CEO flat out stated a 50% quarterly growth surge is physically impossible under these hard limits. Our take is demand can roar all it wants, but if they can't build it, it does not ship. Watch the supply line. It's the one constraint that caps the entire story. Step back a second, because management is really making two big bets here. Bet 1, pricing restraint. The company stated that while competitors hike prices, Microchip is holding its own prices flat. They're trading short-term margin expansion for long-term market share and repairing those customer relationships. The trade-off by industry logic is margin upside now leans entirely on utilization coming back, not on price. Bet 2, capital discipline. The company stated fiscal 2027 capex is restricted to roughly $100 million. That's focused strictly on maintenance and some selective Gen 6 and FPGA testing, very capital efficient. But here's the cost. A reasonable rid is if demand structurally explodes, that lean capacity turns into a hard ceiling. The report frames the whole thesis on discipline. Margin recovery has to come from utilization, not from pricing power. Our take is it's a smart, frugal playbook, but you give up some upside if the boom runs bigger than planned. Last one, let me hand you the dashboard, the things you actually watch from here. First, the underutilization charge. The report says track how fast that $46.6 million penalty decays. Second, net debt to EBITDA. Watch for the drop below that 3.0 times threshold. Third, channel inventory. Track the move back up off that 26-day historic low. Fourth, lead times. Keep an eye on the delinquency rate and expedite requests. That's your supply alarm. Fifth, the data center split. Watch whether management finally breaks out that revenue. Now the company's own June guidance, so you've got a clambering. The company stated revenue up 11% or minus 1% sequentially, with operating margin of 33 now to 34.5%. Non-GAAP gross margin 62.5 to 60.25%, and EPS landing between 0.60 and 0.01. The filing also notes OPEX up about 15 million sequentially, driven by bonus normalization. Track those 5 lines and you'll catch the moment this story either confirms itself or breaks. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar. Hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.